Investing with IBD is brought to you by AllianceBernstein, a global investment manager offering active, flexible solutions across asset classes. AB has the tools and expertise investors need to get their portfolios ready to navigate late-cycle investing. To find out more, visit abfunds.com. Okay, everybody. Welcome to Investing with IBD for March 13th, 2019. I'm Arusha Pires, Premium Product Group Manager. And with me today is Chris Gessel, the Chief Content Officer of IBD. Welcome, Chris.
Hey, this is great. This is our kickoff show. I'm happy to be here.
That's right, our premiere episode. So our goal today, and our goal for this podcast, is we want to share our stock investing strategy. We've been doing this for over 50 years in the markets, profiting off of great bull markets and surviving those bear markets. And the cool thing is this is a strategy that anyone can learn. And the key is to learn about risk management, and also you have an opportunity to learn about these new innovative trends that are going on and these game-changing companies that are changing the world.
We look at those stocks every day, and it's really exciting when you find something new and it really starts taking off. And you know, talking about surviving bear markets, really what happens is you end up thriving because we often get out and we miss the bulk of a bear market, and when the market turns, you're coming at the market from a position of strength, not weakness, and not beaten down because you tried to stay in the market the whole time.
Yeah, as I always tell people, once you learn this, once you learn how to protect yourself, you learn to love corrections.
Oh yeah, that's where all the next big winners come from, and so it's actually corrections are a great time, and we look forward to them.
Now, I think to start off this podcast, this new premiere podcast, we should start with the founder, William J. O'Neill, the founder of Investors Business Daily and founder of a number of companies. And he's the one who inspired me to get involved in the stock market. Now, I was a customer of Investors Business Daily. I was I was reading Chris's articles in IBD, reading the big picture years ago. And and I learned the strategy every day in real time, and it changed my life. And it's all because of Bill O'Neill. And so I have so much gratitude just what he shared, because I know if I discovered this, I would share it with anyone. But you worked with Bill for so many years. You know, you had a chance to work with him. Why don't you share some stories or a story?
Well, I think the thing with Bill is it was always a challenge. He was always coming up with new ideas, and it was just a lot of fun to work with him. And then there were the times when, you're looking at a stock and you could turn to this guy who's like, the master, and say, "Hey, what do you think about this?" And he would always be happy to sit down and take a look at a chart with you and show you might have missed this thing, or this is looking really good. The other thing I would say is, over the years, I saw how quickly he could change his mind about something, and so if he had an outlook for the market, and like, the market's going to be terrible for weeks or months or something like that, and then the market turned, he would be bullish in an instant and be back in buying. And that, I think, is his greatest strength, is that he really listened to the market. He would listen to stocks. We know that sometimes he would be perhaps even almost 100% invested in a single stock, and then a couple days later would be out of it because it started flashing warning signals. So to see it up close and see how he practice it day to day, it was pretty impressive.
Now, one of the key characteristics and behaviors that he always kind of exhibited during the seminars and also throughout his book: rules, discipline, right? Rules.
Right.
We've heard that over and over again. And speaking of rules, being able to listen to the market, like you said, and get in, even though it looks so scary. I remember a story from 2000 to 2002, that terrible bear market. Coming out of that in March 2003, we had a signal. We'll talk about this follow-through signal in a moment, but he was all over it because even though it looked so scary, he was all over it and let the market slowly pull him in.
Oh, yeah, absolutely. And the thing also, I think right around that time is when he bought eBay, and that was a stock that he got some nice gains on. And again, it wasn't that he had some special understanding and really liked buying stuff online, in auctions or anything like that, but it had all the elements that he looks for, and that was, great earnings and sales growth, good sponsorship, and it was coming out of a really well-formed base at the time.
So the strategy that we're going to be talking about, these are all for Bill's. This is Bill's system here, and so every week we're going to be expanding on this and sharing what we've learned. So let's start off with the market. Now the S&P is right now above the 200-day. That was a nice getting through that resistance a few weeks ago, and it pulled back, and now it found support on the 200-day. And it's starting to move up again.
Right. And so we had a really nice move off the bottom. And then on, January 4th, we had a follow-through day. And we'll talk about that in a moment. But, we knew for a number of weeks the market had been up so much that there was going to be a pullback. We didn't know how bad it would be, but, we were getting ready. And in fact, last week we got that pullback. And it wasn't that bad. It was a week long or so. Although some stocks, especially leading stocks, they get hit harder when the market corrects. And so you need to be ready for that. Maybe you're selling on the way up, taking some profits. But the good thing is now we've come out of that. We, at least on the NASDAQ and I think the S&P today, we eclipsed the old high. Now, the S&P has been hitting resistance around 28.15, 28.16 for the last couple months. And so it hit that again. It went above it for a while, and then when the market eased off in the afternoon, it closed below it. So that's still an area of resistance that we need to get through. And then once we do that, then it's only about 4% until the old highs, and that'll be the next big test for the market.
Yep. And now the amazing thing, and this is why you have to listen to the market, we were up an amazing 10 weeks in a row. So you had that really sharp sell-off, the Christmas Eve massacre, I guess as they're calling it now. And then 10 weeks up in a row once we got this fall-through day. And so we're currently up around 13% from the fall-through day. The January 4th, that's when we got our signal to start putting money back to work. And so, let's talk about this concept, this fall-through day. Now, is this a magic bullet? Do you just go 100% in at this point?
No, you still need to let the market come to you. But what Bill observed after sitting through many market corrections is that the market will come down, and then it'll start rallying. Maybe it'll have a big reversal day, and everyone's really excited. But you need to wait a few days and see if there's going to be continued power, and that's where he came up with the follow-through day concept. And usually, what it is, usually 4 or 5. And it can be even much longer past that, but days past the bottom, you're looking for a gain of more than 1.2% in volume that's higher than the day before. And usually it's going to be a lot bigger and a lot more volume because you want that sense of power. There's something changed in the market, and we were definitely getting that sense after a terrible December in the market. I mean, people were calling me and practically in tears that they had been, all their gains for the year had been wiped away. So, there was a lot of fear in the market, and then all of a sudden it hit its peak and turned around, and now the market is acting better. We get this follow through, and now you're starting to look for breakouts and other stocks that are actionable.
Yeah, and really after that fall through day, it's really those next 3 to 4 weeks where it's critical, right, to see if the fall through day can work, and also to see if stocks are breaking out, emerging out of bases, and if that's the case, if it's going to turn into a pretty good rally like it's been so far, you're going to have a number of opportunities, and every few days another stock might give you that opportunity to buy it. And so the market's going to slowly pull you in. And then after 4 or 5 weeks, you might be 100% in the market at that time. So you're really listening to the market and letting it slowly pull you in. And I think the key is, and once again, we've seen it after this fall through day here, you really can time the market. You just have to learn how to listen to it.
Right. And you're never going to get in right at the bottom and get completely out right at the top. But if you're mostly out, near the top and then start getting back in at the bottom, you're going to do pretty well for yourself.
Okay, so coming up after a quick break, we're going to introduce our stock investing strategy and why we use charts to tell us when to get in and out of stocks. So stay with us. Hey guys, Arusha from Investing with IBD here. The global economic cycle is moving into its later stages, creating a less favorable mix of growth and inflation. Central banks aren't providing as much fuel to keep things moving either, and market volatility has come back in a big way. All of this makes investing a lot more challenging today. AllianceBernstein can help. AB is a global investment manager with the tools and expertise to get portfolios ready for a more difficult path ahead. That means finding stocks from companies that are able to deliver quality growth over time. Adding downside protection against market downturns is critical too. And even though interest rates are rising, investors shouldn't avoid duration in their fixed income exposure. The bottom line, investments will have to work harder to generate long-term returns, but that shouldn't mean that investors have to struggle to find answers. AB offers actively managed flexible investment solutions across asset classes. It's what you need to adapt your portfolio for late-cycle investing. To find out more, visit abfunds.com. Welcome back to Investing with IBD. It's Arusha Pires here with Chris Gessel, and now we're going to talk about our investment strategy that was created by William J. O'Neill, the CAN-SLIM system. So here are a few things here. The CAN-SLIM system, the reason why it appealed to me years ago, I looked at a number of systems and I was trying to learn the stock market. It combined the best of both worlds. You're combining fundamentals and technicals, right? And so you're looking for great companies that is always kind of preached out there, but you have some risk management in place. So Chris, why don't we go into the CAN-SLIM a little bit more?
All right. Well, I mean, I guess the most basic thing is we're combining fundamentals, so earnings, sales growth, those sorts of metrics with technicals, and technicals refers to chart patterns and price performance and things like that. And when you put the fundamentals and technicals together, especially when you have great fundamentals and you marry that with strong technicals, that's where a lot of magic happens. And you're latching onto companies that have the chance to really move higher from where you bought them. So that's really important. And at IBD, and I know at MarketSmith because I use MarketSmith every day.
That's what I want to hear.
Right. That the place we start first is with fundamentals, and we're looking at companies and looking for that great earnings and sales growth. And then once we have those companies, then we start looking, okay, what's their chart pattern? How long have they been moving? Are they, is this early in their run, late in their run? We just really want to understand where the stock is in its life cycle.
Yeah, and really to emphasize that importance on fundamentals, CAN-SLIM is an acronym, right? C stands for current earnings, A, annual earnings, and new product and service, right? So it's really emphasizing look for those game-changing companies, these newer companies.
Yeah, and that's why really what we're trying to do at IBD every day is learn the stories behind the companies. So the market writers will discover the companies, and then we'll say, okay, get the tech writers and the business writers to research the companies a little bit more. We have all sorts of stories like that we're publishing all the time. And ultimately we want to understand what's happening there. And is it a game-changing difference? Is it they're just executing better than other people in their space, or is there's an industry move going on, and that can drive a lot of stocks higher as well.
Yeah, and so once you learn this, the standards are pretty high to come across our CAN-SLIM screens like the IBD 50 and things like that. But we're not just going out and buying it at that point. This is where we're actually using charts, and we're going to look for patterns. And really, some of the keys for the patterns are when Bill went back and studied a lot of these great stock runs back from 1900s to 1950s, he noticed there are these patterns that were there before these large moves. And so it helps with the timing and expectations. And that's where that risk management comes into play. If the stock is emerging out of one of these patterns, you know what to expect. either should go up 15-20%, or if it doesn't, and now you're down 5-8% on the stock, you're cutting your losses. You actually have a plan in place. You're planning your trade, trading your plan.
Yeah, it's absolutely essential because a stock can go sideways for months, sometimes even years. Like today's stock of the day, which was Hilton Hotels, it's been basing for a year. So if you thought that, this company looks great and you want to buy it and you just buy it willy-nilly, it could be dead money to you for, months and months, sometimes a year, or it could really be rolling over and that stock that you thought was going to go up is now down 50%, and that's a huge problem, a huge hole to get out of. So that's why we're very careful about when we buy, and we're looking at patterns, and we want to see stocks breaking out of these, especially with volume. And we'll, in this podcast, I'm sure we're going to get into all sorts of nuances on that. But it's really important because, as you said, there's an expectation. When a stock breaks out and it's got the fundamentals, it should be going higher. And if it doesn't, well, there's something wrong. Maybe it's the market. Maybe there's your analysis of the company isn't quite right. But if it's falling, that's a sign that you need to get out and cut your losses quickly and just look for something else.
Yeah, and speaking of the market, we kind of alluded to this earlier. We want to make sure the market's in an uptrend. So we're not going to be buying when the market's in a downtrend. We're going to be on the sidelines. We're going to love those corrections, wait for those stocks to set up, build these beautiful patterns, wait for the market to get in an uptrend, and now we're going to start buying, just like back in early January.
Yeah, absolutely. It's like you're getting a fresh start. And if you miss things before and kicking yourself like I should have gotten this stock or that stock, either it's going to set up and start a whole new run, or maybe there's a new stock that you've never heard of, and you can take advantage of that as well.
And I think, and we'll touch on this in future podcasts, but one kind of key thing that we probably both learned here in-house and how important it is sponsorship. Right? It's not necessarily you found this great stock, you really like the company. The last key, it's more of a kind of confirmation, is who's buying it. And by who, I mean these large institutions. So really, it's the large institutions that are driving these markets up and down. They're responsible for 70% of the movement. And so when you're buying one of these stocks, you want some big friends on your side, to have your back, especially when the stocks are getting hit. And so that sponsorship is key to our investment strategy.
Right. And there's two ways to look at sponsorship. One is just overall, are more mutual funds buying a stock than selling it? So that's a confirmation. And then we also look at some of the best performing mutual funds, and we know something about them and their stock picking styles and everything like that. And, these whether they're Fidelity or T. Rowe Price, I mean, they've got an army of analysts, and they're doing a lot of their due diligence on these companies. And if they're interested and they're buying a company that you've come across and they're putting a ton of money into it, it's a big confirmation that maybe there's something really special going on here. So it's not just is there overall money moving into a stock, but are these key funds moving into the stock as well? And that's honestly, every time I look at a stock that we're considering for leaderboard or for myself, I absolutely look at the sponsorship, and I want to see, are there some of these top funds in the stock, and overall, are more funds buying than selling? Now,
I think probably one of the questions that listeners out there are probably wondering is there's so many funds out there. What's a good list to use to see to track to see if they're actually in those stocks?
Well, there's the mutual fund index, and we publish that in Investors Business Daily, and you can see it daily on the website or weekly in the paper. And then that list is also in MarketSmith, and you can flag those mutual funds and then check the sponsorship of any stock you're looking at, and if they'll show up instantly. Are they in there?
Yeah, so usually a lot of times what I do is if I really like the company, they have great earnings and sales, the last part is, okay, who owns it? And I'm looking for like 2 or 3 of those funds at least in there, because if there's zero, that they've looked at the stock. They just decided to pass, and I've learned that the hard way. There have been some stocks that have just plummeted, and those friends weren't there to buy off the 50-day moving average and support those stocks, and they just left me holding the bag. And so, yeah, you definitely want those big friends there. So sponsorship is absolutely key.
So those elements that we just covered, that's the slim in CAN-SLIM. So we had first talked about current earnings, annual earnings, and new highs. Slim is supply and demand. That has to do with the number of shares, and is there demand for those shares? Is there big buyers? L is leader laggard. Is the stock you're looking at leading the market? Is it a leader in its group as well? Then I is for institutions and institutional sponsorship. We want those big mutual funds buying the stocks that we're buying. And again, M, the last letter in CAN-SLIM, but maybe the most important one, because you always want to be on the same side of the market. So when you put all those things together, you've got a really good framework of how to handle the market, cycle in and cycle out.
Okay, that wraps up our quick introduction into CAN-SLIM, where we're combining both fundamentals and technicals, looking for those game-changing companies, and we're using patterns to help manage our risk. Now, of course, you always want to make sure the market's in your favor and that you have some institutional sponsorship behind those stocks too. So in our final segment, we will discuss some current stocks and also the strongest industry group in the market right now. So we'll be back right in a moment. Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20. You're listening to Investing with IBD. We want to finish off this week with current stocks and what we think is the strongest industry group. So, Chris, welcome back. So let's go over the first stock in this list, and this has to do with 5G and this larger trend that's going on.
Right. So we wanted to talk about a stock that we had on leaderboard, Ciena, and it didn't have a great reaction to earnings last week, but given the way that we handled it and everything, it turned out okay. But I think the real story about Ciena starts back in August, because it was not on our radar list. It wasn't hitting our screens. We knew about the company because years ago it was a big leader, but it had actually been going sideways for years, maybe even almost a decade. And one thing I do every day is I check every single breakout. I don't put any filters except for dollar volume. I want to make sure that it's institutional quality. And every day I check that because I'm looking for stocks just like this, maybe turnarounds, or for whatever reason they've slipped through our screens and we don't know about them. So Ciena back in August had a really big breakout. And again, that's something that we also pay attention to. When a stock has been going sideways and it shoots up, like 10, 15% for the week, and you're thinking, oh my gosh, that's something that's gotten away. Not at all. That's one to keep watching.
Yeah, and so, Chris, when you're talking about August, it looks like on August 30th, they reported earnings, and they had that massive move out of the base at that point.
Exactly. So that caught my eye. And, I told the other guys on the market team about it, and we, were discussing it. And eventually it formed a flat base. And so we put it on leaderboard, I think somewhere in November. It broke out.
It broke on let's see here. It broke out on November 3rd or November 4th.
Right. So we're in the middle of the correction, and we've got this stock that had a big breakout and went sideways when everything else is getting pummeled. And I'm like, this is awesome. This is great. And again, another way that we kept finding this and kept hitting our screens is because that relative strength line kept hitting new highs. And so that kept it on our radar list as well.
Yeah, and let me just throw one other thing here. A lot of times we're going to find stocks exactly the way Chris is talking about. We're going to first see it on the chart, the price and volume action. We'll have an idea of some of these larger trends, but when you're going through screens, you take a look at some breakouts, and you're going to also relative strength. What stocks are resisting the downtrends the best? And that's where you're starting to build your watch list. And now you might even do more research on those stocks that are starting to form bases.
Yeah. So in fact, I remember when I saw it breaking out, I'm like, wow, this is really unusual. I went and read the earnings transcript and, discovered, okay, there's a turnaround. There's, 5G coming up. Things are looking good. So we had it on our watch list. And then when it broke out in November, we put it on leaderboard, and it bounced around the next month or so because we were, still in a correction. And as we've talked about before, it's really hard for a stock to buck the overall downtrend. And it did in the sense that it basically went sideways. So again, its RS line, the relative strength line, was going higher.
And not only did it go sideways, it actually, after breaking out that flat base, it started to form an ascending base.
Yeah.
So even almost the perfect kind of the base bucking the trend, right?
Yeah,
Kept
absolutely.
making higher lows.
Exactly. So and once the market turned around at the end of December, then that stock started going higher. So now it's up. I guess we're in February. It's up 30%. What are we going to do? Well, since this is an early stage base, it really seemed it was showing this great action during the correction. We really wanted to try to hold it. We had taken half the position off prior to another earnings announcement, but now we're up. We got a nice fat profit. And we decide we're going to hold it into earnings, and maybe this is going to be a big winner. And so earnings came out, and it looked like everything was great. Guidance was good. They beat the estimates, all that kind of stuff. It gapped up in the morning. We're happy. We're doing high fives. But then within 5 minutes, it starts fading. And we pay a lot of attention to how a stock really acts once it starts trading in the morning, especially around earnings. So that was a negative sign. It started fading. And it came back all the way to the prior day's close and even undercut that prior day's low. So when you have a stock that is higher than the prior day's high and lower than the prior day's low, we call that an outside day because it covers all the prior day's price discovery plus more. So it's an outside day. It's on the downside, so it's a negative reversal. That's a really bad sign. And so we ended up selling the stock that day, and we did have a 30% gain, but I think we ended up about 24% from the entry point. But I think the larger point on all this is, one, it's important to nail down profits. And even if you had an idea that this was going to be a stock that might double or something, if you get a signal like that, not a good sign. But we've also seen these sort of negative reversals on earnings on a number of other stocks. And so it's really something that we're paying attention to. And I think it happened with Splunk recently. Autodesk was another one we tried to get into, and it didn't work out right. But the interesting thing is both Sienna, Splunk, and Autodesk are all lower than their close on that earnings reversal on that one day. So it's a really good signal when you have something that looks great, but the price is telling you something else. Get out, either lock in your profit, cut your loss, but it's highly likely that that stock is going to continue lower.
Now, the one key thing here for all these stocks, they had these pretty bad reversals, but they are finding support so far on the 50-day moving average.
Right.
And so maybe they hold here, maybe they set up a new base, and maybe they give us another chance to get into them again.
Yeah, that's one of the hardest things to learn when you're investing is when you lose on a stock, or maybe it disappoints you and you had a big gain and you walk away with a smaller gain. It's like, well, I'm done with you and I'm never going to trade you again. And that's really the wrong approach, because many stocks, they might have a breakout that fails, and then they'll set up again and they'll double from there. So you want to keep them on your watch list and keep looking for them, and ideally they'll work the next time.
Okay, so those were some examples of stocks that reversed on earnings and sold off pretty heavily. But sometimes, Chris, stocks can sell off and recover a little bit better.
Right, and an example like that from recent days is Atlassian, and the ticker for that one is TEAM, team, as we just call it. And that was another one where again, it looked like it was going to be great in the after hours market. It opened up, gapped up, and then it started fading and closed lower. And what was different about this one, within a couple days, it actually was already hitting new highs maybe after a week and a half. So it recovered pretty quickly. I wouldn't take that as comfort, like anytime this happens, well, maybe it's the team example.
Right.
We had 3 examples on the downside and one that actually worked. So they can come back, and so maybe you just draw a line in the sand. Do they hold above a moving average or a recent low or something like that, and then they'll resume their uptrend. Although when we had a sell-off in software stocks last week, Team took a pretty big hit, although it bounced back again. It's very resilient, but it's not a smooth ride.
No, and unfortunately, most of the stocks I'm in are never a smooth ride. But let's talk a little bit more about software, because the software industry, a lot of these groups that are related to software, they're the best leaders in the market, and it's amazing. I know in my portfolio, it's almost like I want to buy all of the software stocks. It's all of a sudden my whole portfolio is concentrated in software stocks. But let's go a little bit more into this, because there are a lot of these new innovative companies that come out over the last number of years. Mm-hmm. We're actually using a number of these services in-house to help our operations much better.
Yeah, so what's been great about this is that for the last couple of years, there have been some software leaders here and there, but not this powerful, group move where like all of them are really doing well. And also what's nice is that there's some new names popping up that we, either they're IPOs or ones that we haven't seen before. So anytime you see a group move like this, especially early on in an uptrend, that's something to pay a lot of attention to, because even if you miss these coming out, these are stocks that should be on your watch list going forward. And a couple of them, these are on leaderboard as well. And the first one is CyberArk. So it's security software. And this is one that acted really well during the correction. It made a new low in November, and then when the market was really selling off during December, it actually held above that prior low. So that was a great clue that there was something strong, because so many stocks were just plunging at that point.
I mean, and that was that key divergence that we'll look for during a correction.
Right, and that will also show up in its relative strength line, because all of a sudden when it's performing better than the general market, that line is going to be rising even in a declining market, and even if that stock is going sideways or even a little bit lower. So we put it on leaderboard. It looks like in January, around the 28th, as it broke out, and it's been doing well. And it broke out, kind of held its gain, and then it had earnings recently and gapped up and has been moving higher. So this is a stock that is extended now. I wouldn't run out and go buy it, but it was one of the first of the stocks to break out. It's acted well on earnings during the little pullback last week, the correction. It got support. It definitely sold off a week ago Monday, but came right back. So I would definitely keep an eye on this, and maybe it makes a flat base. Maybe it pulls back to the 10-week eventually or something like that. But I think it's better, especially at this point, to be looking at some of these stocks that are already proving themselves and showing themselves to be leaders, rather than saying, okay, well, I've missed the first group of leaders, I'm going to go buy a second or third tier stock. And sometimes it will work, but many times it won't.
Okay, so that's one to keep on your watch list, CyberArk, and let it prove itself and give you another chance. Let's go to another one, Zscaler. The ticker symbol is ZS.
Right, Zscaler is another in the software security group, and again, we got it on leaderboard back. Actually, this was right. Sorry, I'm going to have to do this again. Sorry. So Zscaler is a stock that we got on leaderboard, and we actually put this on with an option just ahead of its earnings recently. So it had broken out, a couple of weeks before and was going sideways and really wasn't doing too much, but was nice and tight ahead of that earnings report. And so we had an option on it. Limits our risk because the most you can lose with an option is the price of the option.
Right.
But if you're buying the stock ahead of earnings, if it drops 15 or 20%, you're hurting at that point. So this is a stock that was acting well. It's broken out. It's moving higher. Again, I wouldn't chase this stock at this point. I'd put it on your watch list and really look and see if it can make another base or pull back and then get on. It's much better to get in on a second stage base of a leader than try to buy something that's fresh but not all that powerful.
Yeah, and one stock that was just kind of setting up right now and trying to break out again, Salesforce. And Salesforce is a larger company. And so this one potentially could be actionable, but you have to kind of keep that in mind that, hey, maybe this is a lagging stock, though, because it's not into new highs like a number of these other software stocks.
Right. Yeah, it poked into new highs and then it pulled back with the market last week. So it's not acting abnormally, but it has already had a nice big run. It is a lot bigger. It's a little slower moving. And actually, this is something that we refer to as a stair stepper. It pops up on earnings and then goes sideways and then moves up a little bit. It doesn't really necessarily go on to a big run. The good thing about that, the best way to buy stair steppers are on pullbacks, and that's what CRM has done now. So it came down to the 50-day, it got support. It's a little bit above there right now, but it's not super extended. This is one if you wanted to maybe start testing and take a partial position and see if it can make a new high there. And really, your risk is, well, does it close below the 50-day in volume? And so it's a reasonable risk-reward ratio right now.
Okay, so definitely over the next few weeks, over the next few months, when you have some time, start learning about this larger 5G trend. Start learning about some of the companies that are involved in it, and also these software stocks. We definitely think the software industry right now is the leading group. And so you want to make sure you have a number of these stocks that are on on your watch list that might be extended right now, but guess what? Even the greatest stocks are going to give you another chance to get in them, and they're going to form bases, and then you can be in at that time. But be disciplined. Like Bill always says, rules, rules, rules. Okay, thanks for joining us, everyone, for this very first episode of Investing with IBD. I hope you enjoyed it, and we look forward to many episodes together. Tune in next week when we talk about the life cycle of a stock. We just gave you a quick introduction here on how we buy stocks, but there's a lot more to it. There's an actual life cycle for some of these great stocks. And I think, Chris, the key thing is Facebook past its prime? And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube.
If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.